ツマンおじ今日のニュースを読みます。 Reuters. Venezuela's billions in distressed debt. Who is in line to collect? By Rodrigo Campos and Karen Strohacker, January 5th, 2026. The toppling of President Nicolas Maduro has thrust Venezuela's debt crisis, one of the world's largest unresolved sovereign default, into the limelight. Following years of economic crisis and U.S. sanctions that severed the countries from the international capital market, Venezuela defaulted in late 2017 after missing payments on international bonds issued by government and state oil company Petróleos de Venezuela, known as PDVSA. Since then, accumulated interest and legal claims tied to past expropriations have added to unpaid principal, swelling total external liabilities far beyond the face value of the original bonds. Venezuela's distressed debts are rally since U.S. President Donald Trump came to power in January 2025 as speculators bet on the possibility of political change. Below is a look at which entity owes money, what could be included in a restructuring, and who might be knocking on the Caracas door to collect. How much does Venezuela owe? Analysis estimate that Venezuela has about 60 billion of defaulted bonds outstanding. However, total external debt including PDVSA obligations and bilateral loans and arbitration awards stand at roughly $150 to $170 billion, depending on how accrued interest and court judgments are counted, according to analysis. The International Monetary Fund estimates Venezuela's nominal GDP at about 82.8 billion for 2025, implying a debt to GDP ratio of between 180% to 200%. A PDVSA bond originally maturing in 2020 is secured by a majority stake in US-based refiner Citgo, which is ultimately owned by Caracas headquartered PDVSA. Citgo is an asset now at the center of court-supervised effort by creditors to recover value. Who hold what? Years of sanctions, including prohibition on trading Venezuela's debt, have made it hard to keep tabs on ownership. The largest share of commercial creditors likely consists of international bondholders, including specialist distressed debt investors, sometimes called virtual funds. Among the creditors is a group of companies awarded compensation through the international arbitration after assets were expropriated by Caracas. U.S. courts have upheld multi-billion dollars award to ConocoPhillips and Crystal Lakes, among others, turning those claims into debt obligation and allowing creditors to pursue Venezuelan assets to make themselves whole. A growing pool of court-recognized claimants is competing for recovery from Citgo's parent company through the U.S. legal proceeding. A Delaware court registered about $19 billion in claims for an auction of PDB Holdings, Citgo's parent, which far exceeded the estimated value of Citgo total asset. PDB Holdings is PDVSA's wholly owned subsidiary. Caracas also had bilateral creditors, primarily China and Russia, which extended loans to both Maduro and his mentor, the former President Hugo Chavez. Precise numbers are hard to verify since Venezuela has not published comprehensive debt statistics in years. A distant restructuring. Given the plethora of claims, legal proceedings, and political uncertainty, a formal restructuring is expected to be complex and lengthy. The sovereign debt workout could be anchored by an IMF program setting fiscal target and debt sustainability assumption. However, Venezuela has not had an IMF annual consultation in nearly 2 decades and remains locked out of the lender's financing. U.S. sanctions are another obstacle. Since 2017, restrictions imposed under both Republican and Democratic administration have sharply limited Venezuela's ability to issue or restructure debt without explicit license from the U.S. Treasury. It is unclear what will happen with U.S. sanctions. For now, President Donald Trump has said the U.S. will run the oil producing nation. What are recovery values? Bonds have returned some 95% at the index level in 2025. Many of them currently trade between 27 to 32 cents on the dollars. Market access data showed. Citigroup analysis in November estimate that the principal haircut of at least 50% would be needed to restore debt sustainability and satisfy potential conditions from the IMF. Under Citi's base case, Venezuela could offer creditors a 20-year bond with a coupon of around 4.4% alongside 10-year zero-coupon notes to compensate for past due interest. Using an exit yield of 11%, Citi estimates the net present value of the packaging in the mid 40 cents on the dollars, with recovery potentially rising into the high 40s if Venezuela were not hand out additional contingent instruments such as oil-linked warrants. Other investors sketched a wide range. Aberdeen Invest said in September it had initially assumed a recovery of around 25 cents on the dollar for Venezuelan bond, but the improved political and sanctions scenario could lift recoveries into the low to mid 30s, depending on the structure of any deal and the use of oil-linked or GDP-style instrument. What is Venezuela's economic situation? Recovery assumptions sit against the green backdrop. Venezuela's economy shrank dramatically after 2013 when the oil production fell off a cliff. Inflation spiraled and poverty surged, although output has stabilized somewhat. Lower global oil prices and discount to Venezuela crude oil limit revenue gains, leaving little room to service debt without deep restructuring. The recent U.S. blockade of sanctioned oil tankers has exacerbated the situation. Trump said American oil companies were prepared to tackle the typical task of entering Venezuela and investing to restore production, but the Reuters timeline remains unclear. Chevron is the only American maze currently operating in Venezuela's oil field. 以上です。